Hey there, it is Corey here, founder and CEO at Adverse Wealth, and we are joined today by Tom Schubert, Managing Director at Drummond Capital Partners. Tom, thank you for joining us.
Thanks for having me, Corey. Good to be here.
Yeah, thanks for jumping on. So we had you on a couple of months ago, and we had a really insightful market and economic update from you. Looking to do something similar today, and there's plenty of things to chat about. Of course, even just over the course of this year alone, we've had the highest inflation that we've had in decades. We've had a massive spike in interest rates. We've had a significant market downturn. We've got the war in Ukraine and Russia. So there's plenty going on. There's plenty of headlines, plenty of things to think about. And I think as the Aussie consumer, you're beginning to kind of feel these things at the petrol pump and groceries and so on. And a lot of these things beginning to feel real for us, and mortgage repayments jumping up is one of those things as well. So plenty to chat about. Where I'd like to start with you is investment market. So we know we've had a pretty sizable downturn to start the year. Like US market was down 25-26%, going back only a few months ago for 2022. Australian market was down, 15-16% at that point. Both those markets have bounced about 10% since mid-June. So hoping you can kind of speak to that and kind of give us insight into kind of what's been behind that move upward, and have we seen the bottom of this downturn, or is there potential to see markets go lower again?
Yeah, sure. So first thing I'd say is that we'll call this a bear phase, so a sort of phase in markets where the trend is down essentially, and there's a readjustment to the risks out there in the world after a really strong bull phase, that is markets rising quite substantially. And it's probably worth considering, our most recent memory of a bear market is more like a crash, which was March 2020, fastest bear market in history. Markets fell very quickly, but also rebounded very quickly. So this one's more traditional or vanilla, if you will, relative to history. And so it plays out in chapters. And the first, half of this year was really, and we spoke about this on the last webinar, I think a big adjustment to higher interest rates, which impact valuation. So higher interest rates across the board impacting the valuation of all assets and asset markets. And we saw that big, pullback in equity markets. Everyone got incredibly bearish. And as a result, most of the bad news at the time was captured in the price. And it doesn't take much then at the margin for news to be slightly better than expected to see some bounce, as we've seen. That sort of 10% bounce was really, it was hard for anyone to get more negative in June about the outlook. And so you get these phases where the market will snap back. And so the positive news at the margin was we started to see commodity prices pull back. So the war kind of dissipating in terms of its ferocity, I guess. Oil prices, commodity prices start to pull back. Signs of some of the supply chain issues starting to be resolved. And so you saw some commodity prices pull back, some expectation on inflation just moderate, and the market may be thinking that the central banks are starting to get closer to have done enough in terms of interest rates. We still think that was a little bit ahead of themselves. And so it was that sort of a hope of getting closer to the central bank pause or pivot, combined with, getting to the end of the inflation, the worst of inflation, saw the market able to sort of recover quite a bit, and just over the weekend, I think, is now evidence that maybe we're not quite as close to that point. The big Jackson Hole Central Bank forum in the US they have every year, all the central bankers from around the world get together. It must be an incredibly exciting conference to go to.
Hopefully they do some skiing as well. I don't know if there's snow there this time of year, but it's a good spot, Jackson Hole.
That's right. Yeah, I don't think so. I think it's all about the money and what they're going to charge for it. And really important one this year, just given what's happened with interest rates and inflation. And in essence, they've come out and sort of, I guess, stamped on the market's enthusiasm around the end of the interest rate cycle, and confirmed essentially they're going to continue to hike rates and won't be backflipping and cutting it soon. So they're going to continue to rise as towards where the market's forecast, really, which is in Australia sort of 3 to 3.5% over the next 6 to 12 months, and then level out. In the US, sort of more like 3.5 to 4%, and then level out, which versus history is still not that high. It's just the speed at which we've gone from 0 to 3 or 4% is really the sticker shock element there that the economy needs to deal with.
Yeah, it's a good point you make as well. Like we're not moving in a high interest rate environment. We're moving back to more normalized settings.
That's
We're
right.
just getting there very quickly, and we're coming off emergency settings on the back of COVID-19 in 2020 as well. So
Exactly.
there's a few questions in there for me. So in terms of the market and the potential for another kind of downward move in this bear market, like what would potentially be the catalyst for that from your perspective from here, if that was to happen?
Sure. So if we sort of think about it in the chapters, and we spoke about the first half being the equity markets are valued on a price to earnings ratio, so P and the E. And if we think about the first half as really the adjustment to the P, the price, from the impact of higher interest rates, the next question is, what about the E? What about earnings? Because ultimately stock prices follow earnings over the long term. And so where we think the next sort of chapter and probably final chapter of this bear phase is now the market adjusting their estimates for earnings based on the likelihood of a mild recession over the next year. So we sort of think the growth is slowing because of the impact of higher interest rates and inflation on the economy. And then we sort of go into, call it sluggish growth / slightly negative growth over the next year as the impact of those higher interest rates take hold. And so what we need to see come through now, and what potentially causes the market to sell off a little bit, is that earnings forecast for next year from analysts and brokers, etc., in the market are still forecasting a positive 8% earnings in 2023. So growth, essentially. And on our sort of numbers, we look at it and go, well, if it is a mild recession, it's more like sort of -10 potentially. So there's a bit of a gap between what the market is expecting from an earnings point of view and what potentially the likely outcome is if the economy does to tip into recession. Now, we're not saying that's a likely case. There's just a bit of a gap between the two. And so if the market now thinks, okay, higher rates, they're going to keep going with interest rate hikes, we may get that, then we see those earnings downgrades come through. That's your sort of final phase, if you will, of the bear. So the P is adjusted, then the E is adjusted, and then we go, okay, all of the new information and the new outlook, is it now reflected in the price? And that's where we probably start to say, well, there's opportunities for us to start buying and picking up some of the bargains that are out there, because we feel like all of that outlook is now captured in the price.
So even without a potential another leg down now, for that maybe client that's listening or someone else that might be listening to this is thinking, look, I've got perhaps some excess cash and I'm thinking about putting it into my super fund or my investment portfolio, my family trust. What would your general views be for them in terms of, like, is now a good time to be moving money into the market? And if they were to do that, do you have any tips on how they might do that?
It's a great time to be averaging. Like, volatility is your friend when you've got cash that you're trying to deploy. So if you do see those dips, you want to start chipping away and averaging in over the next 3 to 6 months. So I'm not sure how much further down the market goes. Maybe it retests the lows, maybe it doesn't. Maybe the June lows were there, but maybe it gets close or overshoots. It sort of depends how much sort of slowdown actually comes through and how much those earnings estimates are cut. And so, given that we're getting to the later stages of this bear phase, we're by the end of the year, that'll be a full year, and that's kind of consistent with history. And, top to bottom, if you're down sort of 30%, that's an average recession. Down 30 over 12 months is an average recession bear market, if that makes sense, versus history. So you'd have to say that means good opportunities for long-term investors to be, topping up their portfolios.
Yeah. And just to reiterate that point, I think it's easy for people to be trying to pick the bottoms and make sure they get the timing perfect. But if you get the timing perfect, you were just lucky. Nothing really other than that. So just getting in progressively, not having any short-term return expectations is really important as well. And every single downturn we've had in history, whether it's been 10%, 20, 30, 50 in the case of the GFC, fast forward a bit of time so you can look back in the rearview mirror with hindsight. Every single downturn is a buying opportunity.
Absolutely.
If you've got a long-term time horizon, well-set expectations, and the right temperament.
That's right.
I think you've got to have all three. Have a long-term time horizon, but not the right temperament, and maybe getting into volatile markets might not be the right thing. But for those getting advice, we can tend to tick those boxes pretty well.
Absolutely.
Do you mind if I segue a bit for us here, Tom?
Go for it.
So just in terms of inflation, So, I mean, myself, yourself, I mean, everyone that's listening to this will be feeling, the rapidly rising inflation, and like my car's diesel, and it cost me almost $200 to fill the thing up now, which was unthinkable not too long ago. But we've seen inflation get up to, I think it was 6.1% in July here in Australia. And the RBA has been raising rates really quickly to try and curb that. Can you please re-explain for us why it's so important that we do get on top of inflation quickly? And do you have any views on potentially whether we're on track to get on top of it?
I'd say we are. There's two elements that have caused the inflation. We think about there's supply and demand. So the supply shock was all the shortages due to lockdowns around the world, then weather-related issues in food. We know about our lettuce shortages, etc., that have taken place in Australia. Apparently, onions are the next vegetable to cause us to have shortages. And so the supply side, though, is largely working itself out. So there are clear evidence of higher stock levels in retail now. And so to the extent that they now need to discount or work those through, that we sort of think that the supply side is working itself out. Energy markets, commodity markets are correcting. And so on the supply side, there's clear evidence that inflation is coming down. So that's good. The issue is the demand side, and that's where it's a bit stickier. And when I say demand, that's consumers going higher wages. You're seeing, the impact of that on higher rents and demands for higher wages flowing through, and also just retail sales, which have been quite resilient, right? So people are still spending money because they're worried about higher prices in the future. That's the problem with inflation. It's expectation. If you think that the price of the good or service that you want to buy is going up, you'll not panic buy, but start to bring forward your buying. And that in turn drives higher prices, which drives higher wages, and you get that sort of cycle. And so the central banks now, they can't fix the supply side with interest rates, but fortunately the supply side is sort of fixing itself, but they can fix the demand side through higher rates, cooling the economy, and therefore cooling demand. And so as we cycle into next year, really the impact of those higher rates haven't quite hit the real economy. There's generally a 12 to 18 month lag between the interest rate change and the impact on the real economy. And you sort of think about it now, if you look at what a mortgage rate is, people may have only just reset to a slightly higher rate. By the time the impact of the full 3% call it of interest rates come through, taking your mortgage from 2% at the start of the year to 5% potentially, you're talking sort of February, March next year where you really feel that bite. And so as a result, at the moment, people still have some savings and retail sales are there. And so central banks, we think, can get it under control. They're doing it with higher rates, but it's unlikely to fall quickly. And so you sort of have to get there and stay there for a while. And in essence, cause, as we said sort of earlier, a mild recession or a slowdown to take some of the sting out of the unemployment at 3.5%. There's no excess capacity in the economy. And so you create a little bit of unemployment, you create some capacity, you stop that wage pressure, and that sort of starts to cool and stabilize inflation.
Sure. That's a really good rundown. Thank you, Tom. And in terms of the talk about a recession, I think for a lot of people that have got money invested, they hear the term recession and, you start having one of these doomsday type scenarios percolating through your mind. I think a lot of people technically don't even yet know what a recession actually means. Maybe you can explain that. But can you explain for us as well, like if we do have a recession, why investment markets aren't necessarily going to be perfectly correlated with the economic conditions? So you can have a recession, and why you could be in a recession. This was 2020. Yeah, but markets can be potentially at times catapulting forwards while the economy's going backwards and unemployment's at record highs and those types of things. So there's probably about 3 questions in there for you, Tom. But if you could,
no, it's a really good.
I think that would be insightful for many people listening to this.
So equity markets are basically pricing the future, and so generally they will lead the real economy by a year. So what's happening in equity markets now is indicative of what's going to happen in the real economy next year, which is why we're looking at it going, we think there's a recession, earnings are being downgraded, prices have been, we've had volatility, falling prices this year. And so by the time you actually get the recession, i.e. economic growth contracting, you generally are seeing the equity market rally because it's looking to the recovery, and the recovery usually comes through the expectation of rate hikes or maybe some fiscal stimulus or signs that does that make sense? So once you're in the recession, it's like, well, what are we doing to stabilize that growth and actually come out the other side? And so the market then starts to price the recovery. And so the R word might sound bad at the time, but it's probably, if you look at your equity portfolio, it's probably going up, which sounds a bit perverse, but that's the way it goes. And that's exactly, as you pointed out, what happened in COVID. We saw, the market collapse really in March, but the worst of the economic pain not until the second half, when market was really already recovering. Similarly, now we're sort of going through the worst of it. Potentially, the equity market bottoms in this half of the year, and yet the economy may not be in recession until next year. And recession just means you see unemployment rise, you see growth fall or decline. Technically, it's 2 quarters of negative growth, but it's more around how much does unemployment sort of rise through that path. And look, you can have, they don't all have to be like the GFC. You can just have sort of vanilla ones where maybe activity falls 1 or 2%. It's not massive. Unemployment goes from 3.5 to 5 or 6 or 7. You create some capacity in the economy, and then they can start to cut rates, stimulate again, and on we go. So it doesn't have to be a disaster sort of scorched earth like the GFC either.
Said. And to your point as well, I think I saw recently, stock returns from the US market over the last maybe 90, 100 years post-recession. And I think it was like in the 3 years that followed the average US recession, like US large cap returns might have been like 60%, and US small cap returns might have been like 90%.
That's right.
In aggregate over 3 years. So it kind of speaks to the point that when we are in tough economic conditions, and maybe we are, or maybe we're not in a recession, but there's a lot of uncertainty and apprehension, and that sentiment flows through into investment markets, of course, and things get mispriced to the downside because the participants are human beings, and that creates opportunity for for the investor with the right mindset and the right expectations and the right temperament again, and those types of times are the times where you can really amplify your longer term returns.
That's it. Markets will overshoot to the upside and the downside on that, of the long-term trend or valuation based on that sentiment. And so you kind of need to sometimes be counter-cyclical when you're thinking. And we were sort of reducing risk and protecting capital late last year when everything looked rosy because they'd overextended themselves a bit to the upside, in the same way that we're sort of sitting here now going, well, if we do see a bit more volatility, we're sort of rubbing our hands together going, well, where are those opportunities in small caps or large cap growth in the US, getting ready to buy, because the recovery we know can be incredibly powerful on the other side.
So true. I mean, I've had a bunch of conversations with clients this year really, where we might be putting money into a portfolio or have a lump sum of money we potentially can invest, and and I'm telling them, you want the market to take a sizable downturn, like you want markets to fall another 10%, and you can see their eyebrows raised immediately because they're thinking, hang on, we just put in X amount of money into the portfolio, and you're telling me you want it to fall by 10, 15%. Are you crazy? But because we know that those opportunities that are short term, they don't last forever. That's and right. if you get them and take advantage of them, when you look back in the long run, because investing is always about the long run, you can very easily recognize the opportunity. So be greedy when others are fearful, and fearful when others are greedy is the old Warren Buffett adage, and I know that's been part of how you've been managing your portfolios over the past 12 months as well. So
absolutely.
We've covered a fair bit of ground, Tom, and I know everyone listening to this, their time is valuable. Is there anything else you want to add or contribute before I wrap us up here?
No, I think it's been a really good summary, and look forward to the next installment.
Great. Thanks for jumping on, Tom. We appreciate your insights as well, and look forward to talking to you soon.
Thanks a lot, Corey. See you then.
Bye.